Welcome to my channel. I'm Scott, and in this video, I'm going to walk you through the process of valuing Berkshire Hathaway stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 798 billion market cap. They're trading at $367 a share, and they have 2.2 billion shares outstanding. Hey, Ed, what's up? Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Really consistent free cash flow. 26.7 billion in 2020, 26.7 billion in the trailing 12 months. It's also 26 billion in 2021, 22 billion in 2022. When you invest in a company or when you invest in anything, you want to see consistency, whether it's consistently bad or consistently good. Because if it's really volatile, you really have no idea of the future. It's kind of like if you make $300,000 a year, that's your salary. For most people, that's a great salary. You know how much money you're making. You know what you can afford, what you can't afford. Same thing if you make $50,000 a year. You're not going to go buy a $100,000 car if you make $50,000 a year, but you may buy a $100,000 car if you make $300,000 a year, as long as you know what you're making. If one day your boss says, here's $10,000 for the week, then another day he gives you $1,000 for the week, you have no idea what's going on. That's why consistency is really helpful. Of course, you want it to be strong numbers, but my point is consistency, you can predict the future. With crazy, weird numbers, you can't. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's really volatile. And even Warren Buffett says this about his company, is that you can't really look at the net income. Because if you ever look at insurance companies, which they are an owner of many insurance companies, they're actually in the industry. They're in this industry, insurance diversified. You know, it's really hard to value those companies. So net income is really volatile. I'll show you when we look at their 10Q in a little bit why that is. But it's all over the place. It's really strong in 2021 at 91 billion. Then they have negative in 2022. Then back to positive. Warren Buffett says just focus on cash flow for this company. For most companies, especially when a company is dealing with insurance. And I'll show you in the income statement later. Hopefully it makes a lot more sense. Revenue is a great number to focus on too, because revenue is generally the least volatile, meaning there's less accounting tricks or accounting things that can mess it up. I mean, look at 400 billion. It's just crazy. They only had 230 billion in 2022. And because they don't actually do anything. They don't make anything. They're a holding company, and they hold stocks in many companies. The big one is Apple. They own, I think, 10% of Apple. That's their biggest one. That's worth about nearly half this company. But they own like 10% of Chevron, Coca-Cola, lots of companies, Kraft Heinz, Occidental Petroleum. They just, and their revenue growth it went up 24% from 2020 to 2021, down 34% into 2022, up 72%. So revenue is a bit volatile also, but you can see it's real strong. I usually don't do a valuation live. I usually do just whatever stuff live, nothing in particular. But maybe you guys can ask questions while I do this or learn more about my process. So obviously I can't edit, so I'm doing kind of everything at the same time. This is what I do when I make my video, so I can, and of course I edit out all this stuff that you don't need to see, like this part I edit out, obviously. We estimated 4 years of future free cash flows. We also estimated the terminal value. It's all cash flows past year 4. That's $881 billion. We discounted the numbers back to today using the weighted average cost of capital, 7.8%. We get a value of the company of $793 billion. We divide that by 2.2 billion shares. And we get a calculated stock price of 364. They're trading at 367, so they're trading at 1% premium. It's a sell according to the model. Wegro, what's up? Savvy, what's up? So this is really close to where they're trading at. And valuation is an art, not a science, meaning it's not like a math equation. It's not like what's 5 plus 5. That's very concrete. But when you value something, it's a lot of opinion, a lot of my opinion, of course. And my opinion can be different from yours. I try to use concrete ideas to value the company, but of course, I have to put some of my thoughts into it. Like the WACC, I used a lower WACC. I could have used a higher one, like 8.8, and I would have had a 306 stock price, but I didn't. And to get the future free cash flow is generally what I do. And I talked about this in a bunch of videos, is I look at the company's future revenue targets. And you could do this different ways to get their future revenue targets. I just did a simple growth of 5% for the next few years to get their future revenue. And then once I have their future revenue targets, then I figure out what percent of their revenue will they convert to free cash flow. So I just looked at their past to see their revenue and free cash flow, and I applied a 9%, about 9% conversion for that. So they convert between 7 and 9% of their revenue into free cash flow. So if they do the same thing in the future, then I'll get the future estimates. BRK timing with Apple was amazing. They sold in 2019. Looks like it's okay. And then to get the terminal value, you can Google terminal value. What the hell? This formula, it's the same as the dividend discount model. One second. Yeah, the terminal value, if you Google dividend discount model, I thought there's another term. I can't remember what it's called. Terminal value. thought there was another term. Oh, that's it. The Gordon growth formula, which is pretty much identical to the dividend discount model. Am I saying that? The Gordon growth formula. Let's see what it says. And feel free to ask questions. Versus dividend. The Gordon growth model, also known as, okay, so they're interchangeable. So if you want to know how to calculate the terminal value, which is the future free cash flows at any point you can do it. You can predict the free cash flows for 1 year out or 20 years out, and then use the Gordon growth model. And if you understand the dividend discount model, like once you apply, like Google dividend discount model, and it makes a lot of sense why they use it for dividends, because the dividend discount model, you assume like if you buy a stock. Okay, so say you buy a stock $50 and they pay a $1 dividend. Just say it's a once a year thing. So that's a 2% yield. If you're a dividend investor, you should definitely know about this. Okay, so the value P sub 0 is the value of the stock, or the value of the investment today. D1 is the dividend, and then K is a little more tricky. We'll do the is discount rate. Usually it's like, I don't know, it's like the WACC. So we'll use 8%. And then the dividend growth, because the dividend probably will grow. You could look at the company's historical dividend growth. Dividend growth. So say the dividend grows 5% a year. $5 a year. So you take 1 over, 1 is a dividend, over K minus G. So that's the value of the stock today, $33. So in this case, the stock would appear overvalued for a pure dividend play. And there's a lot of because if the stock may go up or down in value. So obviously if it goes up a lot in value, and even if you buy it at 50 and it goes up to 100, it's a great investment, right? Even though it appears overvalued using this model. But on the flip side, it could go down as well. But dividend discount model, I think, is you use it for dividends, but you could also use it for bond, pricing bonds. That's a lot more secure, because generally a bond doesn't move in price. When you buy a bond, it won't. Of course, it moves with interest rates, but it's not like a stock where it just fluctuates a lot. It could fluctuate a lot every single day. Bonds don't fluctuate except when interest rates go up or down. If a stock could go down 60% and still be a great stock, just because there's Somebody sued Coke for drinking Coke and they died. They try to make money from Coke, suing them, whatever. I don't know how you'd sue someone if you die, but their family did. So this is pretty much the dividend discount model, or the Gordon growth model is what I use for the terminal value. And the way I do it is I take J4, which is the last cash flow estimate. So it doesn't matter if you predicted one cash flow year or 2 or 50. The terminal value would just be, you would take the last free cash flow you predicted times 1 plus Q4. I'll show you Q4. 1 plus a terminal value. So you can adjust the terminal value. 2.5 implies the company will grow at 2.5% in perpetuity, but you can do lower. You probably don't want to do higher because, okay, thanks for joining, Savvy, because a company can't really grow more than the entire economy. So you want to cap it usually at like maybe 3% the most. Because if you did put like, say, 5% as a terminal value growth and the U.S. economy grows at 3.5%, then at some point the company would be worth more than the entire U.S. economy, which is obviously not possible. So, and then you divide that by E12. So E12 is your WACC minus Q4. And Q4, I showed you, is terminal value. That's our projected growth. So I don't own any B shares, but I do own 1,500. I own a share, one A share, which equates to 1,500 B shares. So I technically don't own any B shares, but I own one A, which equals 1,500 Bs. And it's not my best. It's my best investment in terms of dollar amount, not percentage. It's one of my best in terms of percentage. I bought it in, I think, March 2017. It was definitely 2017. Hey, Dex. Alex. It was March 2017. I paid $262,000. I added $290,000 to that investment over 7 years. So I had a 112% gain, and the value is $556,000. Let's see. Is it 550? It must be 556. I just pulled this from E-Trade. Yeah, 556, 710. See, if you take the B price times 1,500. Oh boy. Okay. Here's one share. It's $367. So if you do 1,500 times one B share, you get, I don't think it's 367. I think I just rounded it to 367. But it's pretty much, oh, no, it is right because I had a $6,000 gain on my last trading day. So this probably, this is probably a day old, this price. Or vice versa. I don't know. Doesn't matter. But so I'm up 112%. So definitely my best gain dollar-wise for a stock. Probably my home is my best gain dollar-wise. My home is up more than that much. But percentage-wise, God, my new stock is up, I think, 115% the last time I looked. Hey, Maria, and my Meta, well, I did buy Meta recently. Well, 2 years ago. That's only up 8%. But I bought Meta at the same time I bought Berkshire Hathaway. Actually, in 2017, I sold out of all my stocks and I put it into like 4 things. My Meta's up, like, I think 170%. I only have 4 stocks. It's in my retirement account. It's new is not in this account. It's just BRK, Meta, I think PDP, and SPY. And I'm beating SPY on 2 of 3 investments. PDP, I'm not beating SPY. PDP is up like 70%, and SPY is up like 85%. But I don't want to sound like I'm bragging, which it probably does. I'm just trying to convey that I'm not just some guy spewing out information. I can back it up. Not that anybody asked me to back it up. But when do you guys know the reason it's so high? One share Berkshire is more than any other US stock. Like Apple, which is a much bigger company than Berkshire, like 4 times the size of Berkshire Hathaway. One share is 192 of Apple. There's 2 reasons why Berkshire is so expensive. Does anybody know the 2 reasons? I mean, besides running a successful company, which a lot of companies have. There's a lot of companies. Well, there's a few companies bigger than Berkshire Hathaway. Microsoft and Apple are much, much bigger. Amazon and Google are bigger. But what are the 2 reasons this company's stock price is so expensive? Exactly. Wegro got both of them. That's pretty much it. The main reason is he never split. That's the main one. Another reason is not dilution. That doesn't really play into it. I mean, it helps, but is he never paid a dividend, so he keeps all the money in the company. When you keep the money in the company, it bloats the company's balance sheet. It makes the company, because people ask, Warren, why do you give a dividend out? You have so much cash. And his response was exactly all retained earnings. His response was, because I can get a better return than most people. So if I give someone a dividend, they're not going to get a good return with it. I can get a good return with it, and I want to reward my investors, which he does, which worked. And when for a while, people were saying, especially when the stock hit $100,000, even when it was $5,000, it was still expensive for a lot of people. But when it hit $100,000 a share, most people couldn't afford it. So he wanted people to buy the stock and hold it and appreciate the company, because when people buy stocks for a low price, it's very easy to flip them, things like that. But when it's such a high barrier to entry, like the stock price, he wanted people being long-term investors. And he was concerned that the quality of investors wouldn't be as high if the stock price was lower. But he did relent, and in does anybody know, was it What year did they split? I want to say 98, but then I want to say 2005. I can't remember what year they offered the B shares, but it's a decent amount of time. So he goes, okay, I'll do the 15-for-1 stock reverse split, so more people can afford the stock. And he said that the quality of investors, because if you own one B share, you could still go to the annual meeting. He said the quality of investors didn't change. 2010, thanks. By doing this, he said he still had, even people owned a handful of B shares were just as intelligent and just as happy with the company. So that turned out well. But I feel like I'm rambling on too much. There's something else. So the B shares. So it might sound confusing, but it's just like if you own like ADRs, like if you own Alibaba stock, the U.S. stock that trades in the United States, it all comes from the same source of shares. So let's just say, the hell, why is I can't. Say a company has 100,000 shares. It could be, it could be your company, and it could not be a public company, but let's just say there's a public company, 100,000 shares, and price per share. And let's just say, it's $25 per share. So that means the market cap is $2.5 million. So a small company. Now, if he wants, let's just pretend this is a foreign company. Let's say they were in Brazil or something. I don't know. I'm just making it up. And they want to sell ADRs, American Depository Receipts. And they trade, and the ADRs cost $50 each. So one ADR is equivalent to 2 of these Brazilian shares. Let's use euros. Because euro is almost equal to the dollar. Let's just pretend a euro and a dollar are exactly equal, just to make this example make sense. So in Europe, let's just say it's an Italian company. I don't know. They use the euro, right? Italy, they're on a euro. Let's pretend an Italian company that has 100,000 shares, 25 per share. The market cap is 2.5 million euros, and they want to offer shares on the New York Stock Exchange. But the shares cost $50. So it's 2. Let's pretend the ticker is called I don't know, AX. That's a ticker in Italy. So you got 2 AX shares. If you own 1 ADR, it's equivalent to 2 AX shares. Okay. And they usually offer a set amount of ADRs. So let's say this company, of the 100,000 shares, they only want 10% of the shares to be owned by people in the United States. So that's only 10,000 shares. So that means So in the United States, there's 5,000 ADR that trade. Do you know the difference between ADR and ADS? ADRs are, I think I'm saying this right. ADRs are the units. So we call them ADRs, but there's actually ADSs, I think, are the number of shares in the base company. So there's only 5,000 ADRs on the New York Stock Exchange. If you own one, you own 2 shares. That means there's 90,000 shares that trade on the Borsa Italiana. That's in Italy. They all come from the same source. So people sometimes get that confused. It all comes from the same source of shares, the home country. You look at the home country shares. In this case, 100,000 shares of AX stock. If you look at their like their 10K or their offering circulars, when they first became public, it'll mention they have 100,000 shares that are trading in the market. 10,000 are traded in the United States. 5,000 ADRs, but which is equivalent to 10,000 of the company's original shares. So and we're using euros, and we're just pretending a euro equals $1, just to make the ADRs is a receipt as redeemable for shares, right? Yeah, I think that's right. I get them a little confused. Yeah, ADRs, I wrote this down, but are units investors buy and sell on U.S. exchanges. So we buy ADRs. ADSs, American Depository Shares, are the foreign stocks held by the custodian in the foreign company's home country. So there's a custodian, if this stock was trading, and the custodian is a bank, like Bank of America. So the Bank of America will hold the 10,000 AX shares and then issue 5,000 ADRs for people like me and you to buy. And the custodian, Bank of America, handles all the foreign exchange translation, which is nothing in this case. But like if AX pays a dividend, Bank of America, the custodian, would convert the dividend to US dollars Because when you buy an ADR like Alibaba, you never deal with foreign currency. You never have to worry about the converting from Chinese yuan to US dollars or anything like that. You may get taxed, so your dividend may get cut a little because of taxes, but that's a different story. So the price is, if in Italy the price of the stock moves like, because actually people think, oh, I can arbitrage, because what you can do is, let's just say, because the market might not be open, the Italian stock market may be open at a different time than the US stock market, right? Different time zones. So let's say while we're sleeping, the Italian stock goes from $25 to $40, right? So we can just buy an ADR for 50, and then it's 2 shares. Now we own $80 of stock. So you can buy, you go to the Italian market, open up a broker that trades on the Italian stock market. You can definitely do this. Anybody can do it. It's a little more expensive if you want to trade in other markets, but you can easily do it, and then buy up all these Italian shares. Well, in this case, you wouldn't buy any Italian shares. You would buy up ADRs for $25 each, because you got 250, and then sell them on the Italian market. Or if the opposite happens, say we're sleeping and this ADR goes from $25 to $15, there's a big sell-off, right? Then we can just buy up all these AX stocks in the Italian market and then sell them in the US market. That's not illegal. That's perfectly fine to do. The problem is that if just say, for instance, while we're sleeping, this Italian stock goes up a lot from $25 to $35 in one trading day, pretty much the ADR will move in unison. Maybe not exactly. Maybe there's a little lag, because the stock will move in pre-market trading. So when we are able to buy it, it's going to adjust. So we have to pay $70 for an ADR to get 2 shares. So you can try to arbitrage, but you probably won't have any success, because any gap, anytime there's a mismatch in prices, stock prices, you can bet so many people are going to jump on that until the gap is gone. Isn't Citibank a bank that facilitates ADR? Well, definitely Citibank. I mean, pretty much any bank can. Lots of banks do it, but I'm sure Citibank does a lot of it. Goldman, all the banks. It's just a way for them to make money, because they don't have any risk. They just make it on fees and stuff. So when you own shares, like Apple stock is traded in like 15 countries. It all comes from the same source of shares. You see, in this case, doesn't matter where JPM has, all the big banks definitely do it. So if you own stock, some people say, well, I own, if we buy a lot of stock in this company, then where do the shares come from? And are they different from, it's all the same source of shares from that company's home country. We all get the shares from the same place, and then we all trade them between different countries. Does that make sense? ADRs, some people probably knew this already, but I didn't know it a few years ago. I was always curious, like, where do these shares come from? I mean, are they just kind of made up shares? Like, not made up, but like, they just say they're shares in this company, and it helps the other company's stock price, but it all comes from the same source. These 100,000 shares have to be accounted for. There could be 10,000 in the US. Bank of America is holding 10,000 shares and issued 5,000 ADRs. Then you can have another 10,000 shares in the UK. And then you could have 5,000 shares in Germany. And sometimes it's 1 for 1. So if in this case 35 euros, it could be 1 AX share equals 1 ADR. Or it could be, I've seen it where I think Alibaba is like 4 to 1, right? Like there's 4 of the Chinese stocks equals 1 US stock. Or I guess it could be the opposite. It could be like maybe 1/2. Like if it's trading at like $100, maybe, I don't know if they do that. They probably do that. Well, half of the AX stock, 1/2 of AX stock equals 1 ADR, and you could. But they all have the same market cap. Whether you're trading in the US or other countries, it's the same market cap because it's all based on the original country's shares. No one really says, but essentially how it is. Or third order traded. So in essence, ADRs trading on secondary market, but actually third order securities. I never heard of that term, third order securities, but I think I know what you mean. What example of a third market? A third market occurs when exchange-listed securities are traded over the counter between non-exchange-listed brokers. For example, if Abdul's investment bank firm buys stock from a broker that is not affiliated. Oh, you just made it up? That was good because some countries' shares that trade in the United States don't trade on New York Stock Exchange. They trade OTC. And there's some OTC stocks that are worth like $20 billion. But it's expensive to trade on New York Stock Exchange. There's a lot of fees involved. So sometimes the new holdings Brazil is 1/6. There you go, 1/6. New holdings. They don't list the okay. So new holdings is 7.63 Brazilian reais. So he said, are you saying BRL 7. Okay, so if you bought 1 share of Nubank on the Brazilian stock market, come on, it would cost you $1.53 US. So $1.53. So 1 share is 7.6 Brazilian reais, and to convert that to US dollars, 153. So you said 6. So you could buy the new holdings on the Brazilian stock exchange, to Sao Paulo. But if you live in the United States, I'm sure you would just buy it in the United States at 917. which is 1 share. So, of course, come on. So yeah, you're right. Exactly. Good call. This is a good example. So 6 new holdings shares is 1 US share. Obviously, I had to convert to US dollars so we can equalize things and figure it out. But it's the same exact company. Look, 43.6 billion market cap. This is the stock in the United States at 917, 43.6 billion. And then and this is 217 billion, but that's Brazilian reais. And if you convert that to US dollars, it's 44 billion. So it's the same exact value, the company. Is this interesting? This is interesting to me. Is this interesting to anybody else? I feel like some of this stuff gets boring, but 20 Colombian. Yeah, so it's always these, because stocks don't, if you want to get a lot of activity on your stock, it shouldn't be like $2 a share, $3 a share, because most big funds won't buy a stock under $5, even if it's a good company. So you want to make sure the stock price is high enough where it's on people's radars. Because if it's below $5, it doesn't even show up on the list of stocks to buy. Like the bucket shops pre-1920, it technically wasn't even trading securities. It was a fake ADR to bet on. Yeah, let's come up with a fake ADR and make money that way. So this is my spreadsheet. So as I'm preparing my spreadsheet, I use this chart right here. I just copy and paste one of these rows to this row right here, depending on where they are in their cycle. Because I take the last 4 years in Yahoo Finance, and it's always different depending on a company. Some companies have already completed their 2023 fiscal year. Some are still working on just completed 2022 or are still in 2023. There is an exchange rate aspect to it as well. If the dollar falls against the host nation's currency, where the companies trade in ADRs. I went to the European markets. Of course, there's definitely an exchange rate risk. Of course there is, but that gets adjusted too. But you could lose money if it goes against you, the exchange rate. Okay, we spent a lot of time on that, but this is good stuff. It's good to know, because a few years ago I didn't really understand it. I knew I know what I could tell you what things are. I could tell you what a car does. I could tell you the purpose of a car. You drive it, you park it, you use gas to fill it. But I can never build a car. There's no way. Same thing with a lot of things, like in a stock market. I could explain what it does to high level, but to explain the nuances, it's very confusing. Yeah. So sometimes if you were to invest in a country and that country their currency just tanks, you could lose a lot of money even if the company's still growing. It's just because the currency is shit. Like if the company is doubling revenue every year, they went from 1 billion to 2 billion to 4 billion to 8 billion, like the fastest growing company ever. They double every single year, but the currency gets 3 times worse every year. So like $100 equals 1,000 of this, 1,000 whatever of this country's currency. US dollars, and then I'll just call it, it's just I'm going to call it FX. It's just a fake country. I don't know what currency it is. You can call it whatever you want. Country X's dollars, or country X's kronas, whatever you want to call it. So let's say January 2023, $100 equals 1,000 of this country's dollars. And then in January 2024, and say that the company you invested in doubles, their revenue, everything doubles, their revenue, the stock price, everything doubles, but the country's currency went down 3x. So now $100 equals $33 from this country. And let's say the company you invested in doubles again. The stock price, the revenue doubles. But this year, $100 equals 11 of this country's currency. You're losing money. And don't think this can't happen. In Venezuela right now, which is the worst. I mean, they're so inflated. It's like it's not really worth anything. I'll show you the inflation. I know Zimbabwe is really, inflation's going crazy. Inflation by country. I think those are the 2 worst. There's another country that's pretty bad. I can't remember the name. Oh, Turkey. Oh, Venezuela. They don't even show up anymore on this list. Inflation rates. Countries with the highest annual increases in consumer prices: Venezuela, Zimbabwe, Sudan. Yeah, Argentina is always up there. Inflation is just crazy. Unless the company deals in US dollars, then it gets adjusted. But it's still based in the value of the company is based on the stock market where that country is trading. So it could deal a lot with the US dollars, which will kind of hedge against the downside. But it could get a little confusing and nuanced. But that's just kind of a high level example. Now, this is going to be a little tricky because the industry Berkshire Hathaway is in is called insurance diversified. And although maybe 25% of their revenue is insurance, they do have revenue and profits from lots of other companies. So it's a little hard to compare. But these are all 11 companies in the industry, and they spend the most in CapEx. Like the company Berkshire Hathaway doesn't do anything. It's just like 4 guys sitting in an office. One of them is Warren Buffett. Another used to be Charlie Munger, but he died. It's just like 4 or 5 guys. There's not even a secretary, just sitting in an office reading through 10Ks and 10Qs. They just buy other companies. So this is the CapEx. All these, the free cash flow, the market cap. Well, not market cap, but the free cash flow, revenue, CapEx. All these numbers are the companies they're invested in. Like the sum of the companies they're invested in. So 18 billion of CapEx, a lot of that is Apple. Debt to equity ratio, 0.2. Free cash flow, 27 billion, which is more than everybody combined. I think, what are they ranked in terms of largest companies? I'm going to say I'm just talking U.S. publicly traded companies. They're probably like 8th biggest in the world, in the United States. 7th or 8th. So Microsoft is now number 1. It used to be Apple. Microsoft beat, which is really interesting. Let's just answer my question. They're 7th. Berkshire Hathaway 7th. Meta tripled. They were down to 300 billion. I remember in college when I was I don't know why I remember this, but I remember talking to my roommate, telling him how amazing Microsoft is. I don't even own Microsoft stock, which is crazy. I'm like, and he's like, and he was saying, oh, it's not that amazing. I mean, it's big for the amount of people at the company, but like IBM is much bigger, much better. And it's just funny seeing them on the biggest company in the world right now. So Apple, Google, Amazon, Nvidia. I don't own any Nvidia. I own Meta, a lot of Meta. Meta and Berkshire are my 2 biggest investments. I own a little bit of Apple, which is up like 200%. I wish I bought more, but I own Amazon, which isn't doing that great. It's only up like 30% in like 4 or 5 years. I did buy a little Tesla. I'm down the most in that. Walmart's. I own Johnson & Johnson. I'm still down on that, like 10%. Okay. So the other 10 companies, they're strictly insurance. Berkshire Hathaway has to be put into one category. They can't be put into every single category. So they just picked insurance diversified because that was really their main source. But Apple has grown so much that it's kind of like half the company. And that's kind of what happens. Like if you let's say, for instance, you have 4 stocks, just to make it easy. Apple, let's say and this is what investment advisors do, as a term they use. What's another? Let's just do Ford. What's another stock that's kind of popular? I'm trying to pick different, because Apple's kind of technology, Kraft Heinz is food, Ford is cars. I'm trying to pick something, different industries. What's ExxonMobil's ticker? Is it X or Chevron is right? CHV, right? Chevron. Okay. Say you read a book. We'll just pretend you went through an investment advisor, because this is what they do. Say the investment advisor says, okay, you only can own 4 stocks, and we want them to be equally weighted. And every 10 years, we rebalance the portfolio. Well, let's just pretend you own 4 stocks. Say you read a book, right, in 2014 that the best investment is to own a few really good companies and put your money into those few really good companies and make it pretty even. Don't have too much weighted in one company. Make it even across and have them in different industries. I'm kind of just making this up. And that's how your portfolio should be. So you like this book and you're like, okay, this is perfect. This is what I'm going to do. So you pick these 4 stocks, and you have to be equal. And then you only have $40K to invest in 2014. So you put $10K into each and $40K. And say the book said every 10 years you have to rebalance. There's a term investment advisors use, but you have to rebalance your portfolio. And I'll show you what rebalancing means. So you don't even look at your portfolio until 10 years later. 10 years go by. Now you look at your stocks, and now your Apple is worth $150,000. Let me I would edit this stuff out normally, but okay. Rebalancing is good for most people, but if you understand what you're doing, it's essentially selling your winners to buy. JB Weld knows where I'm going, but I'm just trying to show you an example of what rebalancing means. And I'm not saying it's good or bad by any means. But let's just say you read this book, and then this is what you're doing for the rest of your life. Exactly what the book says. And the book said you buy 4 stocks, 4 different industries, and it gives you certain parameters, a PE between this, revenue of this, whatever. So you follow this book to the T, and every 10 years you rebalance. So you started off exactly what the book says, 10,000 each, and you looked at your portfolio in 10 years, or you could look at it every day, but you rebalance every 10 years. And I'm totally making this up, so this is not something I read. I'm just trying to come up with an example. And obviously, Apple is going to go up the most because in 10 years, they went up 15x, probably pretty close to that. So they did the best. Now you look at your Kraft Heinz, and it was 10,000 10 years ago. Now it's 32,000. And you looked at your Ford. I'm not going to say this is accurate. I'm just going to pretend it went down, just for the example. And Chevron, and you did get dividends in Chevron, but you're not looking at dividends. You just look at the value in your portfolio, and that's 57,000. So now you went from 20 a perfect what the book says, 25% each, to like totally lopsided. So how do you rebalance? Well, your portfolio went up a lot. It went from 40 to 247. So you figure out your average. And you don't have to stick with these stocks. If you can, you just pick 4 stocks. That's what the book says. You don't have to stick with the same 4 forever. You four different industries, and then you got to rebalance every 10 years. So so you look at it, 247K, you're really happy because you started with 40. And if you divide that by 4, that means you should have 4 investments at 61,750. So what you do is you sell 88,000 of your Apple. So 2020. So fucking annoying. Why do I gotta deal with this shit? Okay. So on January 1st, 2024, this is what your portfolio looks like. And then we have to rebalance. So over 10 days, you rebalance. How do you rebalance? Well, you get your average of the 4, 88,250. So you have to sell. Come on. God damn it. So change. So you sell 88,250 of Apple. This is your new portfolio on January 10th after you rebalance. I don't like that color. It's for some reason. Okay, here we go. Okay, so you can pick any 4 stocks you want. You keep Apple. You can keep the same 4 stocks for the rest of your life till you're 100 years old. But you say, I want to keep Apple. But you have to sell 88,000 of Apple because each share has to be 61. The value of each stock in your portfolio has to be 61,750. So rebalancing. And that's your new portfolio. Kraft Heinz, let's just pretend you want to keep Kraft Heinz too. So you have to buy 29,750 of Kraft Heinz. Now you have 70. Now you have 61,750 of Kraft Heinz. So let's just say Ford, you're like, okay, I'm done. I've lost money, so I don't want to have any more Ford. So you sell. Okay, you sell 8,000 of your Ford, and you buy Tesla. Say that's your car company. You want to stick with cars, so you buy 61,750 of Tesla. Chevron, you want to keep Chevron as well. You like it. You like that's your oil play. So you have to add 4750 of Chevron because it's 57,000. So that's pretty much what rebalancing is. If you're, your broker or your investment advisor has all these buzzwords. Okay, we need to rebalance your portfolio. That's pretty much what it means. You keep a certain percentage in this stock, certain percentage in that stock. It doesn't have to be like this. It could be anything. You might say when you first sign up with your financial advisor, he said, okay, what percentage, here's your write down, okay, stocks. What do you want in stocks? What percentage of your portfolio? And you say, okay, I'll do 75%. And then you go bonds. What percentage in bonds? 20%. And the rest we'll keep in cash. So if it's out of whack, out of this balance, then he'll have to say you had Apple and it went up a lot. Now you're 85% stock because Apple went up so much. You have to sell some stock, and so that's pretty much what it is. Okay. I'll be back in 1 minute. Okay. Nobody left. Okay. So in 2024, you have to follow this book. Now you're rebalanced and your portfolio is that. And then say 2034, you look at your portfolio and you keep doing that. That's what rebalancing is. I don't do it. I don't rebalance. But I mean, I buy and sell stocks as I feel I want to, but I'm pretty much all equity. I do have one bond, but I don't. That's actually, I've had it for like almost 10 years. It's going to mature, I think, this year. So it'll turn into cash, but I don't buy bonds. So let's go back to this chart because we want to get to the 10Q. That's, I think, the most interesting. Alex, if you have questions about your taxes, let me know. But thank you for watching instead of doing your taxes. That it could be really dry. So it is hard to look at the price multiples for this company because they're so mixed. Price to book, really good, 1.5. And it's hard to compare because these are all insurance companies. So insurance companies are going to have a much lower PE than like a consumer, a pharmaceutical or a regular consumer products company. Price to free cash flow is 30, which sounds high, but I think that's pretty good for this company. Price to sales 2.0, but it's hard. It's very arbitrary, these numbers, because of the insurance aspect. Look at that revenue, 400 billion. Not many companies ever hit that level. And then 5-year annual revenue growth rate is 9%. Revenue is, I guess, a pretty good indicator, although with insurance companies, revenue is kind of debatable how you look at it. Look at Goosehead Insurance, 35%. Has anybody ever heard of that, Goosehead Insurance? Okay. So once I get this set up, I move these columns in, because when I upload the video to YouTube, I put the link here, because this is my last video for Berkshire Hathaway. I put the link there, so the link uploads to my chart. This is my tab with all the tickers I've done since I started the channel. So there's well, that's hard to see. 929 rows. Some of these tickers I've done multiple times. Problem with Berkshire, the numbers do not show the retained earnings of its portfolio. And the link is here because you can see it pulls from the tab. It looks into the tab with the same name. Right now, there's nothing in no YouTube link because I haven't uploaded the video. So everything's kind of in this tab. If you want this, I could email it to you. This shows the result. I don't have the result for all the tickers because as time went on, I kind of evolved my spreadsheet. So for the first few years, I didn't have all the information put into this one tab. So this is when I did the video in August 2023. So 9 months ago, my target was 387. Now it's 364. So it's kind of it's tough to value these companies. Hey Premium, what's up? I'm working on another video right now, Corteva. Okay, so let's go through the 10Q. So this is what Warren Buffett does. He reads through the 10Q and 10K. This is their latest 9/30/2023. And generally the first page shows you the securities the company has issued. So they have 2 equity securities. They have the Class A common stock. The ticker is BRK.A. One share is like $560,000. They also offer Class B common stock, ticker BRK.B, which is 1/1500th of this stock. So 1,500 B shares equals 1 A share. And remember, it all comes from the same source. It's not like he had to add more shares. They just converted some of their A shares into B shares. And it also shows the debt the company issued. Corteva was a Dow Chemical spinoff after they consolidated with DuPont. Exactly. Corteva, I think DuPont or Dow DuPont, they spun off Corteva in 2018. It's an agricultural company, Corteva. So the idea of a spinoff is that if you have a company with a lot of different divisions, sometimes it's easier for that company to operate on its own and not part of a big entity, just to focus. It's kind of like if you're a Zara, you sell clothing, you sell really high-end clothing, and that's your focus, is high-end clothing. If you're ShopRite, I don't know if everybody has a ShopRite where they live. You sell like grocery store food. Like you sell a lot of stuff. You sell napkins, paper towels, cereal. If you're a Walmart, you just do everything. Not everyone's a Walmart. Some people specialize. So they just kind of spun off one of their entities so it could just focus. Okay. Worked with Andy Lavaris and said he was a smug ass, but very smart. I'm kind of bullish on Kyndryl. IBM did it with Kyndryl. I have a family member who was an executive at Dow in the early 2000s and told me not to invest in them. Interesting. And they issue debt because debt is a cheap way to finance growth, much cheaper than equity. So they have these 2024 notes they probably issued 10 years ago at a 1.3% interest rate. They're maturing this year. 2025 notes at a 0% interest rate. You might think, like, why would they issue 0% interest rate? Like, who would ever buy a bond at a 0%? Does anybody know who would buy a bond at a 0% interest rate? A lot of people do. Zero coupon bonds. I mean, it's similar to a regular bond because if you buy a bond, say you buy a 5% coupon. I'm getting on such tangents. I hope people bought negative rate bonds. So just the simple concept. Say you buy 5% coupon bonds. So principal. Say you invest $10,000 in these 5% coupon bonds. So the bank you buy it from say it's a 3-year coupon. Year one, at the end of year one, you get $500. At the end of year two, you get $500. At the end of year three, you get $500 plus your $10,000 back. So that's a 5% coupon bond. You get that 5% each year. A zero coupon bond, let me separate this. Say you put $10,000 into a zero coupon bond. I shouldn't call it interest. I'll call it like return. what's your return? Year 1, well, 0, because you get no interest. Year 2, 0. Year 3, $11,500. If they offer, like, they're not going to say a 5% zero coupon bond. You just get the lump sum payment at the end, and you could you can do the math and figure out, wow, if I get $11,500 after 3 years, then that's a $1,500 return. So what percentage do I have to, like, what percentage is my interest? And if you did the math, you would see it's a 5% implied yield. It's just paid off in one shot. So you wouldn't get your $10,000 back after 3 years, because nobody would invest in that bond. It's an implied yield, and you could calculate implied yields, and obviously the value of any bond. So if interest rates go up, because you pay $10,000 for this zero coupon bond, right? Say you did it on January 1st, 2024, you pay $10,000. So if interest rates go up a lot, say interest rates, say the bond yields up, like the average bond yield is 3%, and say it doubles to 6%. Do you think this $10,000, do you think it'll be worth more? What's the value of this bond if interest rates double to 6%? You think it'll go up to $11,000, or do you think it'll go down? The fuck? If you want to sell the zero coupon bond in the open market. So if interest rates go up, if they double from 3% to 6%, do you think the price of the bond you could sell it for will go up or down? I'm claiming Patreon, seeking out for audible, car-related expenses since I'm a gig worker, phone bill, all deductible, either for work-related. I'm claiming rent, but Scott would have to confirm this. What do you think the answer would be? If interest rates go up a lot, does the value of bonds go up or go down? Well, I don't know what you do, Alex. If you're an independent contractor, you can claim a lot, but if you're just a regular W-2 employee, you can't really claim anything. That depends what you do. So if interest rates go up, do bonds, does the value of a bond go up or down? I mean, you could claim it if you can justify that it's part of your job. Yeah, if rates go up, bond prices go down. If rates go down, bond prices go up. They're inverted. Exactly. They work opposite. And if you're not sure why, it's kind of boring if I go through it. I did it on another video. I could show you how the bond price moves. But if you're getting a 5% rate, right, on this bond, and rates go up, say they go up to 10%, why would anybody buy your 5% bond for $10,000? Right? It's pointless, right? Because they can spend $10,000, get 10%. Why would they? So you'd have to sell your $10,000 bond for like $8,000 just to get someone to buy it. And that whoever buys it gets a 5% return. I'm just throwing out numbers. But the same thing, if rates go down drastically to 2%, then this $10,000 bond is worth a lot. You could probably sell it for $13,000 because a lot of people would want to buy your bond for $10,000 and get a 5% return because they can't get that in the open market. But I keep getting off on these tangents. But anyways, they issued debt that matures in 2027, 1 1/8 interest, 2028, 2030, up to 2059. So this is the debt they issued. Is it always possible, though, to buy a new bond from the government? You could always buy a bond from the government, of course. They sell lots of bonds. But the interest rate changes a lot. But generally, if you buy a government bond, everybody gets the same interest rate if they bought it today. But if you bought it a year from now, everybody gets a different interest rate. So the value, if your interest rates go down a lot, like I remember in the 1980s, you could have gotten like from the government like 18% bonds. You give them $10,000, they give you 18% interest because rates were like through the roof. To get a mortgage, it was like almost 20% interest rates. I wonder if that was from the savings and loan crisis that rates went up so much. But anyways, so if you locked in an 18% interest rate, a guaranteed 18% interest rate from government, and then a decade later, rates are down to like 6%, your bond is like gold. Like, it's like you can sell it for a lot of money. Okay. But it helps me too because it refreshes my memory on this stuff, especially when I explain it, because sometimes I forget. And if I had to calculate bond yields, I could do it, but I'd have to. I would learn as I'm doing it because I haven't done it for a year or whatever. But it's a good refresher. Okay, so let's look at. Well, let me turn down the heat. It's getting too hot here. Okay. Okay, let's look at their income statement. So the income statement, sometimes they don't call it the income statement. So if you're new to this, it could be confusing. They call it the consolidated statement of earnings. But anytime you see revenue on top and net income, well, net earnings on the bottom, that's the income statement. This is the most probably common financial statement. Most people understand this and look at this the most because it makes the most sense intuitively. So it shows the revenue the company earned on top. And for the third quarter, $93 billion of revenue. They own the companies. The companies they own, that's how much revenue they generated. $21 billion in insurance premiums. They own all of Geico, 100% of Geico. They own a lot of other insurance companies. One of your attendants taught me to start looking at high PE stocks for future growth. High PE stocks. I'm not saying high PE stocks are better than low PE stocks or vice versa. It's in relation to the value of the company, right? So you're going to get more growth with a high PE stock. That's funny because I remember on a video, I said, oh, they have a really attractive PE, 8.0 PE. And then somebody commented, said, yeah, they do have a good PE, but why does Tesla have a 200 PE? This is a few years ago. And I said, well, then the market is expecting really high growth for Tesla. That's why they have a high PE. And he goes something like, you're an idiot. You don't even know that it's the low PE is the better situation, not the high PE. And then when I had to explain to him, or sometimes I just send him an article from like a financial website, and that shuts them up. But yeah, the higher the PE, it indicates that the market is projecting lots of growth in the future. Now, if you could find a low PE that grows a lot, you'll be killing it. So the market's not always right. 21 of insurance. Sales and service revenues, that's their big one. Apple's part of this. 39 billion. Yeah, it's industry specific, which is very true. Leasing revenues 2.1 billion, and they earn a lot of interest and dividends. They earn billions and billions of dollars in dividend, and just in the third quarter, 4 billion of dividend payments and interest. And they own lots of railroads and utilities. 26 billion in railroad, utilities, and energy. So total revenue 93 billion just for one quarter. And here's a different breakdown of the revenue. Manufactured products, industrial and commercial products, 7 billion. Building products, 5 billion. Grocery and convenience stores, 8 billion. Okay, McLean, service and retailing, BNSF, Berkshire, Hathaway Energy. Okay, Geico alone, almost 10 billion of revenue from Geico. Pilot Travel Centers, 13 billion. What is Pilot Travel Centers? We acquired control of Pilot Travel Centers, and PTC is a considerable segment, beginning interpretation revenue, spike test earnings, PTC, previously. Yeah, I'm just curious what it is. PTC is headquartered in Tennessee, operates travel centers in North America with more than 750 travel center locations across 44 states. So is it a travel agency, or they actually fly planes? They operate large wholesale fuel and fuel marketing platforms in the U.S. Okay, interesting. Well, Buffett knows what he's doing, so. Gas stations with trucks, big rigs. Okay. Okay, gas stations. Yeah, energy. Selling gas and energy. So the total revenues are $93 billion and derivative losses of 30 billion. That might sound bad, 30 billion of losses. But this is kind of like a timing thing, because if the market has a really big quarter, like say the stock market goes up like 20% in a quarter, then they have to report that as a gain on all the stock they own. Or the stock market goes down a lot in a quarter, So like, say this is your portfolio. And this is your portfolio, say, and if you had a holding company like Berkshire Hathaway, you might have to report quarter. And say you have a lot of stocks in your portfolio, you trade in and out of the stocks. And let's just pretend you created a company where your friends and family can invest in the companies. That's how you get all this money to buy stocks and things like that. That's what a holding company essentially is. He built it to the biggest holding company in the world, but you might just have $10 million in your holding company or whatever. I'll just make it simple. So let's just say in the first quarter of 2023, and just we'll keep it simple, where you had $1 million of friends and family's money invested in this portfolio. Let's just pretend nobody put money into it all of 2023. They all give you money last year, 2022, or 2 years ago. And let's just say in the second quarter, the market struggled. The market, like a lot of stocks went down. So you have to report a $15,000 loss. I think they might explain it here. And Warren Buffett always says this in his meetings, like to ignore these kind of like timing differences. But he had to post a $30 billion loss. It might sound bad, but on your income statement that you have to prepare for your friends and family, the investors, you show a $15,000 loss on your investments. But you didn't sell anything. That's just the value of your investments went down. So let's just pretend okay. We'll call them this is a really simple holding company. Such a dumb accounting rule. I mean, it is and it isn't, as long as you understand the reason for it. So the way you make money, this little holding company you have, is, well, you could obviously sell stocks if they go up. But let's say you're not focused on, you're not selling them at this point because it's an active business. So the way you get income is dividends from the stocks. So let's say and we're doing, you're preparing a 2023 income statement for your investors so they can see how the portfolio did. So dividends received is your income. You don't have any interest income. Let's just do dividends received. So that's real money, real income. But you had a loss on the stocks, which you have to report on your income statement. So we're not doing taxes or anything like that. It's a real simple. So you show this to your friends and family, and they're like, "Oh my God, you're terrible. You lost $13,000," and then you explain to them, no, the market went down. The market's volatile. It's going to go down every quarter, every now and then, maybe every year. But for multiple times, if after like a 5-10 year period, it will go up, guaranteed. But like it might go down a quarter, it might go down for 2 straight years. But in the long term, it's going to go up. They're like, oh, okay, thank God. And let's just say a second COVID happens in 2023. Oh, we could pretend this is 2024 or whatever. And the market goes down. Again, you get 10,000, 2,000 in dividends for the quarter from your investments, but you show your third quarter income statement and your friends and family like, oh my God, you lost $8,000? That's 8% of what we gave you. And you're like, okay, it's okay. It's okay. The market fluctuates. In the long term, it will go back. And then you showed them, say the market rebounded. And again, you get your your $2,000 in dividends, and you show them the income statement for the fourth quarter, and they're like, wow, you're a genius. You made $32,000? How do you make so much money? We only gave you $100,000. That's but you show them, I only made 5% for the year. You gave me $100,000 at the end of 2022. You all gave me $100,000, and then I turned that into $105,000. And they're like, oh, 5%. They're like, oh, 4.8%. That's not a great return. And then you say, well, what we also got 6,000 in dividend payments, right? Because that's real money. So not only did you get, our portfolio is worth 105,000, plus we received 6,000 in dividends. So that's actually, I actually return you guys 10.5%. And then, then your friends and family go, oh, you're really good. You're really good at what you do. So for 2 straight quarters, you were an idiot. You lost everyone's money. It might look like, oh my God, what a crappy year they had, or crappy quarter. Look at 82. He lost $82 million, and then he got 38 million gain. But it's all fluctuational market. It has nothing to do with the company's fundamentals. So this is pretty much what Warren Buffett's company goes through, these really big fluctuations. But it's just a stock market movement. It's not like he actually lost this money. It's all on paper. Okay. And then the expenses on the income statement. These are all the expenses for the underlying companies. Underwriting expenses, cost of sales. He owns like 10% of Coca-Cola. So all their expenses to make the product or to make the syrup, whatever, all the expenses on those companies' income statement. But then if you look at his net earnings, he had a net loss of 13 billion for the quarter. And last year, for the third quarter of 2022, is net loss of 2.7 billion. So it looks like the company's not doing that great. But then if you look at this is the first 9 months of 2023, they had a net gain of 59 billion. So it's hard to look at the income statement for insurance companies, and this has a lot of insurance on it. You could see the shares outstanding have decreased. He only sold 21 A shares. Oh, no. 20,000 A shares, sorry. It went from 1.46 million to 1.44 million. And for the B shares, if you times this by 1,500, so let's just times that by 1,500. So this is the B shares. I don't know why it's not exactly. I mean, it's pretty much the same. If you times 1,446,925 by 1,500, it's almost exactly this. It's off by 190. I'm not sure why. I guess there's fractional shares in there. I don't know. But Buffett even says the statement of cash flows will adjust all these accounting discrepancies. So the statement of cash flows shows the first 9 months of the year. So the first 9 months of 2022, that's this column, they had a net loss of 40 billion. For the first 9 months of 2023, a net gain of 59 billion. That's a $109 million difference. $109 billion difference. It's a big swing, right? So that's how the operating cash flow, it starts with the 40 billion, negative 40 billion. It starts with the positive 59 billion. But when you do the accounting adjustments, you can see actually they had 27 billion of cash flow in 2022, 35 billion in 2023. Because you have to adjust these investment gains or losses, 38 billion, negative 38 billion. It's a positive 38 billion. That was the stocks went up. He owns by 38 billion. But it's a non-cash item because he didn't sell those stocks, right? They're just still sitting in his account. Like you didn't sell these stocks. You never actually lost the 15,000, the 10,000. You still held the stocks. It's just on paper, it went down 15,000. So on paper, it went up 38 billion, but it was not any cash. He didn't sell the stock. So you have to minus it out on a statement of cash flows. Same thing with 2022. He had a loss of 82 billion. You have to add it back here because he didn't actually lose any cash. So that's how you adjust and make the because cash is king. So follow the cash. And then in the investing section, it's a lot of, he invests a lot in like really safe investments because they have so much cash. They purchased 178 billion of US Treasury bills because they don't want to just sit on cash. They want to get a little interest. And they're financing cash flows. He buys back lots of stocks, 7 billion in 2023, 5 billion in 2022. Because if you want to know what stocks they own, I don't know if they listed here, but you can look at a balance sheet. They have 25 billion of cash, 126 billion of short-term investments in treasury bills. So it's pretty much like they have 150 billion of cash to work with. But if you want to see what stocks they own, they have 318 billion of investments in equity securities. Remember, your little company, you had 100,000 of investments in equity securities. He has 318 billion. So let's see if they tell you what the 318 billion. They don't list it out. They just say of the 318 billion, $62 billion in banks, insurance, and finance companies, $180 billion in consumer products, $74 billion in commercial and industrial and other. So about half the company, half the equity securities is Apple, because Apple went up so much since he bought it. He probably spent like $10 billion on Apple. Now it's $156 billion. So that's half of his equity securities. Bank of America is $28 billion. Coca-Cola is $22 billion. Chevron is $19 billion. Well, Amex is $22 billion. So almost 80% of his portfolio is in 5 companies. And there's something called equity method investments, which is different than equity securities. Equity method investment, it's mainly 2 companies this $27 billion is made up of, like Chevron and Occidental. Not Kraft, Heinz, and Occidental. So if a company has significant influence over another company, then they have to use equity method accounting. And generally, significant influence, it's kind of like, how do you define significant influence? If you buy Apple stock, you don't have significant influence over how the company runs its business. You have no influence. But usually they define it, if you own between 10% and 50% of a company, you have significant influence, where you can actually make changes to the board, make decisions for the company, like influence the company's decision making. So there's 2 companies that they have that type of influence: Kraft Heinz and Occidental Petroleum. So it's a different type of accounting method. Other companies like Geico, they don't have significant influence. They have pure influence because they own 100% of Geico. So they don't. So it's slightly different accounting. That was a mouthful. So total assets, $760 billion. Oh, no, sorry. Then they have their railroad, utilities, and energy assets. PP&E of $170 billion of that. So over $1 trillion of assets on their balance sheet. Liabilities, about $500 billion. Their liabilities have a lot to do with insurance, unpaid losses, and loss adjustment expenses. This is an insurance thing. They have to report. These aren't actual losses. These are losses they're probably going to pay. If it's on the balance sheet, it means that thing didn't happen yet. It probably will happen, but it's sitting on a balance sheet and waiting for those losses to occur, and then they'll actually move it to the income statement. So the assets minus liabilities is their equity, $525 billion of equity. Most of that is retained earnings, $569 billion. We know retained earnings is a sum of all their prior net incomes. And they bought back $75 billion of their own stock. And they raised $35 billion from selling stock. Capital in excess of par value. Do you guys know the difference between... I did a video on this. It's called connecting the income statement, balance sheet, and statement of cash flows. So on his balance sheet, common stock 8. That's 8 million common stock, and capital and excess is 34 billion. I mean, common stock is like an arbitrary value. So the way it works is, say you have a company and you take them public. Say you issue 1 million shares of stock. So you go public, and then the IPO price is $15. Okay. So by going public, you raise $15 million, and then you put that money in your pocket, and then you buy a nice house, you buy a yacht. It's your money. You can do whatever you want with it because you own the company. You own 100% of the company before the IPO. Now you don't own any of the company. But you're probably the CEO, so you still have to run it and get a big salary. So you raised $15 million from going public. Now, each share, is what's the term? It's par value. Each share has a par value associated with it. It's usually like a really small number. Like sometimes it's even like a penny or 1/100 of a penny. So let's just, I think a common one is 1 penny, the par value of the stock. So on your balance sheet, when it says common stock, you have $10,000 of common stock on your balance sheet. Dan, what's up? How's it going? So your balance sheet says common stock 10,000, but this is an arbitrary value. It's kind of meaningless. The reason they use par value is just to keep track of the shares in the open market. It's really a meaningless value. But then capital in excess, since you raised 15 million from the IPO, the capital in excess is 14,990. 14,990,000. And then the sum of these two numbers is going to be the 15 million. But let's just say you IPO, say it's January 2024, you IPO $15, right? Let's just say the stock triples. In February 2024, it triples to $45 a share. Now, how much does anybody know how much your common stock will be and your capital in excess will be? Knowing this information, we IPO'd at 15, right? So we raised $15 million. We issued 1 million shares. Now, how do these numbers change? Once the stock goes up 3x in 1 month, everybody buys it. What does anybody know? What would I change these numbers to? Remember, this is on the balance sheet. These values are on the balance sheet because you have to report what the company's worth. So what's this number? What's this number in February 2024? Because when you look at the balance sheet, two main things. You want to see how much the company raised, they raised $34 billion from selling their business. Let's just ignore the 8 million. And what did they do? What were their retained earnings? Historically, were they a profitable company or did they lose money? We can see they're very profitable. We gave Warren Buffett $34 billion, and he ran a business that accumulated $570 billion in earnings historically. He did buy back stock, so that does bring down your equity value. But that's how you see the value of the company. You take what they raised, the historical profits, and then you have to minus buybacks. So the value of the company is $525 billion. So he's grew to a really successful company. So this is what you have to look at. Sometimes it's negative retained earnings. So the company took in all this money, they raised all this money from selling their business, and they lost money from running their business. Well, I think no one's responding, so I think people have left the stream. So the answer is these don't change. It doesn't matter what the stock does in the secondary market, whether it goes up 50x, goes down 90%. This doesn't change. The company doesn't profit when a stock goes up. The main benefit to the company when a stock goes up is that they can issue more shares at a higher price. Does that make sense? So people think, oh my God, the company must be so happy the stock went up. It doesn't affect the company at all. When I say the company, I mean the corporation, the corporate entity, not the individuals that work at the company. The CEO is just an employee of the company. Of course, he's going to probably benefit. He probably owns a lot of stock. He has options, things like that. So the people who work at the company may benefit. Some may not. Some may not own stock. But the company, the corporation, doesn't benefit when a stock goes up or goes down. It's really arbitrary to the company. It shouldn't matter too much unless they need to issue stock or buy back stock. When a stock goes down a lot, then that's a great opportunity for the company to buy back shares. Just like us, if the stock goes down a lot and we like the company, it's a good opportunity to buy the stock. And if stock goes up a lot, it's an opportunity to sell the stock. Yeah, of course. Any company that offers employee stock purchase plan, this is generally how it works. ESPP, employee stock purchase plan. I would always do it. So I think it was by quarter. So say at 1/1/24. I think it. Okay, I worked at Assured Guarantee. I remember doing the ESPP. I did it at other companies too. I did it at JP Morgan and Radian, but AGO, Assured Guarantee, insurance company. The way the plan, the employee stock purchase plan worked is if, say, a share of stock was $25 on 1/1. On 3/31, say the share stock was 35. So you can elect a certain percentage, say up to 5% of your pay. I think it was based on percentage. I don't know if it was dollar amount or percentage. So you can say say I said, okay, I will buy 5% of employee stock. So every paycheck, they take 5% of my pay out of my paycheck. And say once the quarter ends, say on April 1st, they took out, let's just say $10,000 from my paycheck throughout the quarter. They will buy stock at the lower of these two prices. So the price on 1/1 was 25. The price on 3/31 was 35. So I think they actually gave you a discount on top of that. So they would take the lower of the two and give you a 10% discount. So on 4/1, they would automatically buy stock at $22.50 a share, even though it's $35 a share. They would give me at $22.50 a share because it's the lower of the two with a 10% discount. And they would, and then they took $10,000 out of my paycheck throughout the entire first quarter, because every week they took a few $100s out and put into an account. And so they would give me 444 shares. They would put into my account. I still have, every quarter I get a check from Assured Guarantee. It's like $30 for the shares. I think they're options. I don't think they're shares. I can't. The dividend check. So I guess they are shares. So they would give me 444 shares for that $10,000. And then on April 2nd, if I wanted to, I could take these 444 shares and just sell them at $35 a share, because that's what the market is. And I get a 50% return. Boom. Right away. Let's just say it was reverse. Say on 1/1 it was 35. On 3/31 it was 25. So they would take the 3/31 stock price and give me the discount. So they would take the 3/31 stock price because it's the lower of the two and give me a 10% discount. So it'd still be $22.50 per share. They would buy 444 shares. And I could turn around and sell in the open market only at 25, because that's what it's trading at today. So I could make an 11% return, right? So in the very worst case scenario, I would get an 11% return if I sold it right away, in the worst case scenario. If the stock went down. If it went up, I could make a huge return. But I usually wouldn't sell it. I would usually sit on it and just let it accumulate in my account. Have you ever? Well, Starbucks is my first job into that. Never took advantage of the employee stock purchase plan. Yeah, you should always do that, because you just get a discount on the stock and you could just sell it right away. Some people didn't want money taken out of their paycheck. They needed it to like eat and if rent. But if you have the money, you guarantee to make. There's only one tiny risk, which is very minute. Say say this is the example. It was 35 on 1/1, 25 on 3/31. So they would give you 444 shares at $22.50. But let's just say the market was really, really volatile on your stock. And then between the time you got the shares and the time you sold it, and it could have been literally, you only had an hour between in that one day, the stock, say the stock went down from $25 to like, say on April 2nd, it went down to like $20. Like it crashed in that one day. So then you could only sell it for $8,900 and you would lose money. But you don't have to sell it. You can just hold it. If it went down, whether it goes up or down. So they put in their money to incentivize you to make the SPP. They wouldn't put any money into it. They're giving you stock in a company, which it's their stock. So they can, they own it already. It's not like they had to buy it really. They would just give you a discount on the stock. Like they would have in their account, they would maybe have a brokerage account called ESPP, and they would keep like 1 million shares in the ESPP account. It's just like you would have your own brokerage account with shares. They have their own brokerage account and they call it ESPP account. And then, at the end of the quarter, they would pull from it. We have to give Scott Rubin his 444 shares. Jim Jones gets 8,000 shares. Say he makes a lot of money. Mary Smith gets 30 shares. So it makes sense to them because they're not really paying for the stock. It's kind of free to them. So they're just giving you a discount on the stock. And it's not usually that many shares anyway for the company relative to how many shares in the market. So they would put their money into the incentive to make use of the SPP. I hope you at least dip the shoes in gold and put them on your wall. I did not laugh out loud. So that's generally how ESPP plans work. I don't think they're all the same, but most of them are kind of like this. Some companies may not give you the discount. They just might give you the lower of the two. Or some companies, I guess, if they're not, generous companies, they're very tight with their money. They may give you just whatever it was trading at, 331, even if it was a lot lower. Even if you lose money. So look at the end of 2022, their Apple stock was worth $119 billion. And then 9 months later, $157 billion. Just that one stock went up about $40 billion. They didn't sell it or do anything with it, but just the value of that stock went up 40 billion. That's a lot. Okay. All right, the next part. I forgot about this. Okay, so here's the B shares. So it looks like the B shares started trading in 1996, May 96, or pretty close to May 96. So the B shares, when they started trading, they were $20. So one A share was $30,000. So when they did the conversion to add B shares, I remember when I started following the stock market, it was I think I was like a junior. It was in 93, 92, maybe 93, when I started following the stock market. And I remember it was 17,000 for one share, because I would just look at the prices. That was how I followed the market. I didn't even look at anything. I was just like, oh my God, look at these prices. Look how they move. And I always look for like the big prices. And Berkshire Hathaway always stood out. I was like, $17,000 for one share. That's like all the money I made in my bar mitzvah. I'm like, who would do that? Why would anybody pay that much money for one share? And if I put all my bar mitzvah money, I'm sure I wouldn't have kept it in there for 3 decades. Which would have been cool if I did. I would have had a 3,200% return on my investment. And instead, I used my bar mitzvah money, and half of it I gambled away, because I got really into gambling, betting on like baseball and football games. I remember I had almost 20,000 in my bank account, and this is like at 15 or 16. Half of it was bar mitzvah money. I think 10,000 bar mitzvah and 10,000 from being a paper boy. And there was a local bookie, so I would bet on football games and baseball games. And you know, when you win a few games, you're like, oh, I'm invincible. I want to be a millionaire. And then when the account got down to $10,000, I gave my mother the checkbook. I said, just take it, because when I got to high school, she gave me the checkbook. She had her own checkbook of mine, but she gave me the ability to take money out of the bank when I got to high school. And I gave it to her back. Didn't you say you worked for First Boston? No, I didn't read that book. Yeah, I when I was in high school, I worked at First Boston. It was in 93. Right when I started working at First Boston, my first week, somebody bombed the World Trade Center. And 8 people died. Hardly anybody remembers that, but that was the first bombing of the World Trade Center in 1993. It was like in the basement part of, I think, World Trade Center 1 or 2. I worked in 5 World Trade Center, and so it wasn't. We didn't get affected really. I mean, no one got too affected. Of course, there was some damage. I mean, in 9/11, 5 World Trade Center ended up getting taken down because it got beat up and all the debris from 1 and 2 hit it. I mean, thank God I didn't work in there during 9/11. But yeah, in 93, I started at First Boston in 5 World Trade Center. So I could have put my bar mitzvah money in Berkshire Hathaway. Instead, I gambled it away. Half of it I lost, and then I just gave my mother my checkbook, and I said, I can't do it anymore. I'm going to lose too much money. But anyways, $20 in 96. And then, I mean, the growth wasn't too dramatic. I mean, it definitely moved. By 16 years later, by 2012, it only doubled or tripled. I mean, the real growth was, I guess, starting in 2012. It shot up to 360 at its peak. I remember in 2017, 10% in March 2020. Thank God I held on to it, because look where it is. It's so much higher than pre 2020 levels. And they do a good job at decreasing shares outstanding, 2.46 billion in 2018 down to 2.19 billion in 2022. Has BRK beaten SPY gains? Yeah, that's an interesting point. I remember in 2017, I bought 4 stocks. Well, it was called Facebook when I bought it, but it's called Meta now. I think it's PDP. I can't remember if I think it's PDP. I own 2 ETFs. I don't know the exact percentages, but this is roughly how it was. I remember like in 20, I bought it in 2017. I remember like in 20, it's something like this, the percentages. I can't remember the exact numbers. But it was like after 1 year, I was up like 8%, 20%. I forget what this is, and like 6%, something like that. I can't remember the exact numbers, but I remember somewhat the trend pretty much. And then after 2 years, I was up total on SPY like 18%, 52%, and 14%. And then it was definitely more than that. What am I saying? Because I was up like, I remember it was up around 50% before COVID. And then around COVID time, the peak of COVID, my SPY went down to like 7%. I went from up 60% on my investment to up 7%. Meta went down to like 30%, and BRK went to like, it was down, and then it rebounded after COVID into 2021, and then my Spartas was up like 34%. Meta was at its peak, it was like 175%, and BRK was like 28%. And I was like, why did I buy Berkshire Hathaway? It's never beating the S&P 500. And then it finally turned around in 2022. It was like 65%. And of course, Meta was down to like, and then Berkshire Hathaway finally was beating Spiders. And then Spiders at the end of 2023, it's up like 180%. Finally, Meta came back. That like tripled in 2020. And then so something like that. That was like the trend. But for 5 years, I was like, from 2017 when I bought all this stuff, I was like, God, Berkshire Hathaway. And that was the most, because it was like, I think I put 270K and then 100K and 100K. Why have you always been bullish on Meta? I don't know the exact numbers. But I know this is a pretty close trend. And the other one, the PDP, I only put like, I think like 25K, like, so, and that's up like, I don't know. I know it's doing the worst. So two of my investments are beating S&P 500. But yeah, BRK, I was like, I put the most in that one, and I was like, damn, it can't beat the S&P 500. But now, but who knows? In 5 years, it may be totally different. Why do I like Meta so much? Well, I mean, I could explain why. Because besides Google, besides Google, they have the most people who go to the website. They have the most people that visit the platform. Facebook still, it has how many members of? So it has 3 billion monthly active users. Google, I think, has more people going to the website to use it. 3 billion. So like, I think like, what's the world population? 8 billion. So they have nearly, and they have Instagram too, WhatsApp. So about half the world is on that platform. It's a lot of people. Google may have more people, but people don't really go to Google as a destination. They'll go there to search, to find a link and then go to that link. But people go to Meta and just sit there and do things. Sometimes they spend hours on the platform, like talking to people, writing things, going through Instagram. So it's a good place to advertise, right? That's why their revenue, advertising revenue, is pretty much almost as much as Google. Was it like 40 billion a quarter in advertising revenue? So it's a lot of eyes. If you want to make a lot of money, you can build a website and don't have to charge people. I don't pay Facebook anything. You can have a free website. You just need people going to your website. If you have enough eyes on your website, then you sell ad space. It's hard to get people to go to your website. It's even harder to get people to sit on your website and use it for a long period of time. If you can get people to go to your website and spend an hour a day on your website, which is nearly impossible to do, you have a pretty valuable tool right there. And the great thing about the revenue for Google Meta is it's all margin. Because if you built a website, say you built a website that gives detailed information about baseball statistics. So if you want to know anything about baseball, like the history, the stats, you go to your website and you can learn that. A lot of people go to your website because they love baseball. The people who like baseball, they go to your website. So if you can get people just sit on your site for a long period of time, it just makes it more valuable, and you could sell ad space. So once you have your website built, your baseball website, it may take a lot of time because you have to keep adding stories to the website. So you maybe have a few employees who help you, as it gets bigger, you might hire more people. So you have a baseball website, and if it's just you by yourself, say you had 100,000 visitors a month at your website. Okay. And just say, and if you were doing it by yourself, you have a lot of content. You're pulling stats from different websites. You have a lot of content, but it's only you. There's only so much you can do by yourself. And let's just say, so each month you have 3 million minutes of view on your website. You have 100,000 visitors. The average visitor is 30 minutes per time there per month. They may go multiple times a month, but they spend about 30 minutes per month. So 100,000 visitors times 30 minutes, 3 million minutes viewing your website. So ad space. So you could charge, like if somebody wants to put an ad on your website, so they click in and buy things. Say you charge $50 per ad, and they could leave their ad on for a week. If they want a whole month, they pay $100. Let's just say $50 per ad. And you could you probably know this, but I'm just giving you how Facebook makes money. Okay. So let's say the average ad space is $50. Some pay a little more, a little less, depending on how big the logo is and things like that. But you could only fit 100 ads on your site to make it so it's not taking up too much space. So each month you make $5,000 in ad revenue, because $50 per ad, you could only fit 100 per ad. And based on your view time, that's how much you can charge, $50. So make $5,000, and if you're by yourself, so how much are your expenses? Probably not much. Probably like you have to pay for the website, search engine. There's some smaller fees you got to be a member of some other site or information. So your expenses, say only $1,000. So your profit is $4,000 a month from running this website, which isn't bad, I mean, this is what Google and Facebook do on a much larger level. So you got 80% margin. But if you're able to get a lot more info, like good stories on your website, interviews with different baseball players, and say you could 5x your visitors, and then say each visitor spends 90 minutes per month. You have some long videos people view. Now look how much your total minutes went up, from 3 million to 45 million. So now your ad revenue went up 15x. Let's just say each ad now goes up 10x. So you could charge 500 per ad space. You still only have 100 blocks. But your expenses go up a lot. You have 50,000 revenue per month, which is great, but your expenses went up because you hired a couple people to help you. So your expenses went from 1,000, 10,000. Your profit is 40,000. So you are now making $40,000 a month. But you could see it's just very profitable business model because it's not that expensive. Because once you get the site set, your site, it's really, every time a new customer comes on board, you don't have to do anything additional. It's very little added because, they're not even paying you anything, the customers. So it's kind of a set site. You might want to add these nice features to increase your visitors and average time spent. But I mean, it's all profit. You don't have to like make something in a factory. So it's just a good business model. Of course, it's not easy. You have to get people to stay on your website. So I just think it's a good business. But there was MySpace, which was, I remember MySpace. I was like, this is the greatest site, MySpace. And then we thought it was going to be number one forever because it brought everyone together. It was the first site to do something like that, where you had your own page. It's kind of like you had your own website, your own MySpace page. You can decorate it however you want. You can personalize it. Then Facebook took it over. Okay, so last but not least, Simply Wall Street. Okay, we'll take a look at the stock on Simply Wall Street. 377 stock price, 788 billion market cap, up 1% in the past week, up 18% in the past year. They say the company engages in insurance, freight rail transportation, utility business worldwide. It provides PNC, property and casualty insurance, life, accident, lots of insurance, railroads. But they do everything. I mean, they're in pipelines, LNG. They hold interest in coal mining assets. They sell soft drinks, furniture. I mean, they're invested in a lot of companies. Incorporated in 98. That's just when the B shares came out in 98. Simply Wall Street at 712. It's 48% undervalued. Because there's a lot of value in Warren Buffett. That's a lot of the intrinsic value is pushed up for his knowledge. Hopefully the stock doesn't go down when he goes away. There's no analyst estimates. Maybe on A shares there's analyst estimates. This is a cool chart on Simply Wall Street. I should show this in my videos, but so they get their revenue. This is for the trailing 12 months. I think they use a different time frame than Yahoo Finance, but 350 billion for the trailing 12 months, and it's broke. And here's how they come up with their revenue: manufacturing, other segments, service and retail, 40 billion. So here's what feeds into the revenue, to 349 billion. And of that 349 billion, 100 billion, almost 100 billion is gross profit. 75 billion is cost of revenue. And then earnings of 77 billion. Actually, it's not as clear as I thought, this chart. It kind of makes sense. That's the thing about tech. It's good until better tech comes out. I mean, it's a risk. Tech, any company is great until somebody makes a better product and makes them obsolete. Tech is a little more like that than most, because for a time anybody could have created a website and compete with anybody. It's a little harder now, but even it's still now people can come up with a better product. Remember Yahoo, that search engine? It was such a nice search engine. Everybody used it until Google came out. You can see this red line is their debt. They have more cash than debt. So when a company has more cash than debt, it just means they're pretty much like debt free, because they could pay off all their debt if they wanted to. But it's kind of like if you have, like say you bought a home for $300,000 and you paid down a lot of it, you have $100,000 left on your mortgage, and say you had $120,000 of cash. Would you use all your cash, most of your cash, $100,000 to pay off your mortgage? Probably not. You want to have some cash left over, and if you have a low interest rate, why pay down your mortgage? Maybe you can make more money investing, or maybe you just want to have cash in a bank because it makes you comfortable, so just in case something happens. They don't pay a dividend. This is the longest video I've done, I think. Warren Buffett's salaries, I think he's been $100,000 for a long time. That's his salary. So some of you on here make more money than Warren Buffett. And his total compensation is $400,000. That includes stock options. But he has a lot of money in a bank, his personal bank account. He's CEO 54 years, older than most people watching. A couple of insider sells in the past year. Half the company is owned by institutions, 37% by the general public, and 15% by insiders. Warren Buffett owns 15% of the company. You know, interesting thing to think about. Microsoft. Remember how like Jeff Bezos and Elon Musk, they were worth like $200-300 billion because they own so much of their company? Because at one point, when Microsoft started, Bill Gates owned half the company in the beginning. Eventually, he sold off shares. So if Bill Gates didn't sell off all his shares, he could have been a trillionaire. Actually, he would have been a trillionaire a few years ago. He would have been worth $1.5 trillion if he never sold off his shares. He'd be the first trillionaire in the world. But he's not I don't think he cares about that. Elon Musk does, but I don't think Bill Gates really cares about money that much. See, where do we leave off? Okay, so top shareholders, he still owns 15% of the company. I think he sold shares in the past several years. He's been selling some shares, but so his value of the company is $118 billion. So he's worth at least $118 billion. And I'm sure he has other money from other investments. That's why he doesn't really take much of a salary. I'm surprised he even takes $100,000. He should take $1. I think Zuckerberg salary is $1. The Bill and Melinda Gates Foundation owns 1% of the company. Just that 1% is $8.2 billion. Any other names on here? Employees. These are the employees of the companies they own, 383,000. And the ticker trades in all these places: Deutsche Börse, Mexican Bolsa, Swiss, London Stock Exchange, like 20 places. Okay. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching. Okay, that was a 3-hour stream. Thank you for commenting. I think we lost a lot of people throughout the stream. It was like almost 30 at one point, but a lot of dead space. Because I would edit all this stuff out and put it into like a 10-minute video. Normally it takes like 45 minutes to do the video, and then I edit it down to like 15 usually. Okay, well, maybe I'll do a live stream tomorrow on dividends. I think that would be a good one. Dividends, normal dividends, like 10% dividends. Last stream I did 20% or above. Okay, see you later.